Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, October 28th. Positioning, positioning, positioning. We talk about some of the intricacies of trading in bonds and stocks and commodities, all the markets. And one of the things we talk about is how is the market currently positioned? We got a rip higher today based on that negative positioning that we've seen the last 3, 4, 5 weeks. We saw the record flow into inverse ETFs. Those are ETFs that are betting on the market going lower. We saw in terms of dollar amount a broad spread between puts to open, betting the market would go down, versus calls. As a matter of fact, the spread borders on the highest it's ever been just 10 days ago. When we start to see that kind of negativity, it doesn't take much to get the market going up. Or, by the way, when we start to see too much greed, too much flow into certain assets, it doesn't take much to start to see that asset go down. We have a term, buying begets buying, selling begets selling. On the way down, you get selling 2 or 3 days in a row, it starts to hit stop losses and accelerate. So in terms of what we're seeing this week, we've got earnings, we've got some inflation news, but none of it by itself bad enough to justify the positioning. And therefore, you start to get covering of the people that are out of position or short the market, and you get a day like today, followed by a pretty decent month. We're closing in on the end of October. I'm going to put a chart up right now. You know, as this chart goes up, probably hard to believe that old Papa Dow up over 12% over the last 30 days. This is a 30-day snapshot. What's working? Healthcare is working. Banks are working. Industrials are working. Energy's working. As a matter of fact, if we look at asset class size in the equity arena, small and mid are really outperforming large cap. That's similar to the 2004-2006 period, that stretch from late 2004 through 2006 when the Fed bumped rates 15 meetings in a row. You got outperformance out of small cap and mid cap. Now, there'll be people that'll try to explain why that happens. We're more interested in what is happening versus why it's happening. We'll find out why 6 months from now. But in terms of some of the sectors that I just mentioned, they've been building bases nicely now over the last 4, 5, 6 weeks. As a matter of fact, some of these areas are trading above their August highs. Remember, we had that nice spike late July. We talked about how negative the market got. Into mid-August, we had a very nice move. As a matter of fact, I remember one Friday being on here and saying, you know, the Dow's only down 7% year to date. That didn't last long. We had a horrible September, weak beginning of October before we started to recover. Right now, the Dow is inside of 10%, so down about 9.5% year to date. Again, hard to believe. That's not the case for the S&P, down double that. Look at the NASDAQ. Still, even with a little move today, down 28%. So within the broad indices, have some capital allocated to what's working. And then when we start to strip down away from the broad indices, try to keep your eye and focus on large versus mid versus small. In our U.S. core, we're properly positioned there. I would say in our U.S. ETF, we've done a good job of positioning there. Tactical needs to get more small and mid cap exposure, and we have the cash to do that. Next week, I want to talk a little bit about international. International has been trading much better with the exception of one giant, and that's China. China's a horror show. And what we have to keep an eye on is, does China roll over and start affecting the recent bid we've seen in India and some of the other emerging markets. We'll talk about that next week. Have a great weekend. Now we're going to go over to the Moose. He's taping remotely this week.
Hi, I'm John Mousseau. I am the President and CEO of Cumberland Advisors. It is Friday afternoon, October 28th. I'm talking to you from New York, visiting clients here. In the bond markets, tale of two markets this week. Treasuries down in yield, 20 basis points, a little more across the board. This morning they have a 10-year Treasury at 4, a 30-year Treasury at 4 1/8. Just the opposite on municipal bonds. Yields up about 30 basis points to where you're like a 380 on a 10-year AAA and on a 30-year AAA at like a 410. That is an incredible move up. What happened? In the Muni side, you saw a pretty good amount of supply, and you basically saw dealers unwilling to take any risk in pricing deals. So, as we know, lots of deals get priced much higher than the AAA scale. So we saw lots of deals this week coming at 5% or cheaper. A total giveaway. It's the only way to describe it. And at the same time, with Treasury yields, you saw those come lower. And what's going on there, some of it is technical, but when you look at it, the markets on Treasuries, which are the most liquid markets in the world, are essentially telling you that the markets are thinking that the Fed may be slowing down here at some point. We know the Fed meets next week to talk about raising short-term interest rates. It's pretty much a given that they will raise things 75 basis points on Fed funds rate. And then, of course, there's another meeting in December, and people are talking maybe 50 to 75 again. At that point, you will be well above 4, depending on how much above 4. But the talk is, does the Fed start either talking about pausing or talking about pausing? And at that juncture, markets will start to coalesce. We're going to be watching the 10-year very carefully in the next few weeks because you may be in a trading range between a 4 to 4.25. But when we look at some of the underlying numbers, we know we're going to have an inflation number next week. That will be very important, or the week after that, excuse me. We're going to have, of course, the unemployment rate next week. That will be very important with the jobs number on Friday, the first Friday of the month. But if you start to look, and for example, the PCE deflator came in today. That's the number the Fed likes to watch. Came in month over month at 0.3. It was 0.3 last month. The expectation was 0.3. Multiply 0.3 times 12, 3.5%. That is certainly not where the Fed wants it, but it is hopefully moving in the right direction and stabilizing. And we'll know more from the inflation numbers as we go forward. We know that housing is down. We know that new sales are down. We know that prices are down 2 months in a row, and the increases in housing the months before that were lower and lower numbers. So housing has now gone into a different mode, and we know that mortgage rates are much higher. So we expect the economy to slow down. If it hasn't started a recession, we can argue about the difference between a recession and a slowdown, but we certainly think that's in the cards and has already started. You're starting to see layoffs in certain companies, etc. So we think the bond markets may be stabilizing on the Treasury side. We think the muni markets are a total giveaway. And at Cumberland, we're extending the maturities and durations, continue to do so, and lock in rates that we haven't seen since the taper tantrum of 2013. We hope everybody has a good weekend, and we'll see you next week.
Thank you, Moose. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. And just as important, you can get any midweek updates that we occasionally pass along. Enjoy the weekend.